Well, it is shaping up to be a big week for the broader tech story, with the likes of Apple, Amazon, and Meta all reporting in the coming days. Until now, a big revenue miss for Snap and signs of a dire online ad market has been the major warning sign for the space. The Nasdaq has plummeted over 30% since the start of the year, outpacing declines for the S&P. The sector has also been contending with what my next guest calls a COVID hangover because of tech overinvestment. Let's bring in Erika Klauer, Jennison Associates Tech Equity Portfolio Manager. A lot to get through to this week, but let's start by looking back to what happened last week. We saw the huge sell-off coming on the back of Snap that has accelerated concerns about a decline in online ad spend. How much of that are we going to see reflected, especially in Meta and Alphabet?
Well, Akiko, we talked a little bit about the fact that a lot of the advertising at Snapchat has basically been a result of share loss. I think relative share gainers will be companies like Google, like Facebook. Nevertheless, there is a lot more pressure in terms of justifying the price of advertising online that I think will persist throughout 2023.
And so when you look at somebody like Alphabet, what we have learned, at least from the past few quarters, is that they are a little more diversified when it comes to this online ad spending. So obviously it's not like Snap where we're just talking about one particular app, a specific market. Does that shield Alphabet for some of the headwinds that we've been seeing in a company like Snap?
I think you're absolutely right. Google is much more diversified than a Snapchat is, and same goes for Facebook as well.
What about Amazon? They have been making a lot of big inroads, especially in the advertising space.
That's right. I think Amazon has done a very, very good job with its advertising assets, and I expect that division will continue to outperform and gain share.
So how do you think investors should be looking at that? We'll sort of break down Apple separately. Obviously, there's a lot to get into there. But when you talk specifically about the stocks that are really affected by digital ads, and we're seeing a pullback in general, who's best positioned? Who do you stay away from?
Well, I think overall spending will be somewhat pressured because there is a need right now to really look at all costs amongst all enterprises. There is rampant inflation with regards to labor costs and also input costs. So clearly people are going to be scrutinizing their advertising budgets more than ever. However, in that context, the companies that are really executing and gaining share would include Amazon, Google, and Facebook.
Let's talk about Apple. There's the obvious, numbers that we look for in terms of where their demand is on iPhones, how they're expanding in services. But there's a larger story that I think a lot of investors are looking at that puts Apple right in the middle, and that is supply chain movements. We were just talking about China and the concerns that persist around there. Apple has a big presence. They've been trying to move production into India, away from China. And then there's this big tech controls crackdown that the Biden administration has put forward that does affect Apple and where they source their chips.
Well, if we take a giant step back, what we're looking at this week is a cumulative $7 trillion amount in market value of companies reporting this week amongst the big tech players. The advertising companies are in one bucket, and then, of course, there are the hardware and software companies in the other bucket, including the likes of Apple. And what I would say about Apple is that the company is executing extremely well, but it is not immune to the trends that you just mentioned. It took decades to basically to consolidate all of their manufacturing in lower cost regions. That's being undone right now as the supply chain is being diversified. So ultimately, that is inflationary in its nature. And at the same time, we have a much more difficult demand environment where many people bought their smartphones, they bought their personal computers during COVID. So there's not that dramatic need that we've seen over the last 3 years to upgrade or even to attract a first-time buyer.
When you talk about the shift in where manufacturing is happening, where you source your supplies, what does that specifically mean in terms of inflationary? I mean, are we looking at higher prices down the road? Is it going to be cushioned by the company just given the cash pile that they have? I mean, how do you see that being reflected in the coming quarters?
Well, there are companies that are just masters of their supply chain. Apple would be the poster child for that. However, I think that when one is thinking about duplicate efforts to ensure no disruption to supply chain, that inherently means higher costs. And so the company will have to really assert its pricing power in order to offset those higher costs. I think that's going to be a story over the next couple of years.
Still the strongest name, though, in the big tech space?
Absolutely. I think Apple is showing very strong gains in market share. Even now with its dominant position, it's still outpacing its peers in terms of adoption.
Erika Klauer, Jennison Associates Technology Equity Portfolio Manager. It's good to talk to you today. Appreciate your time.
Thank you.